Hey, thanks for stopping by. We really appreciate it. Remember to hit that subscribe button. Remember to hit that like button too. We appreciate each and everyone's support. Your donations go for a great cause in supporting the financial literacy of children and those that are underprivileged. Mm-hmm. Oh, so you want to learn about stocks today? Don't feel like you know enough? Don't know where to go? Don't know how to start? Oh, we got one for you today. What are stocks for beginners? I want to give you a basic understanding of what they are, an inside peek at what it's all about, and what they can do for you. Woo-wee! You know what that whistle means. It's game time. Let's get it. Okay, let's first start out by saying you need to take some sort of notes, okay? You need to develop some sort of journal or note-taking system that will allow you to reflect on situations, keep track of particular stocks, companies, important notes and information that you need to obtain and reflect on along the way, all right? So let's get into the nitty-gritty of things. All right, let's define stock. A share of stock represents a share of ownership in a company. Okay. So imagine this great company that you've got in mind, and it's broken into so many pieces. And you own shares of stock represents the amount of pieces of that company that you own. So let's say you purchased some shares of stock and you purchased a total of 10 shares out of a total of 100, then you own 10% of that company. An example of a stock may be examining the company by the name of Walmart. All right. Walmart has a stock symbol of WMT. WMT. They utilize these symbols when you do the trading of the particular stocks. Probably one of the most important things to know is the price of the stock. You have the opening price, you have the current price, which fluctuates throughout the day, and you have after hours pricing. A lot of things about pricing that you need to know. Now that we've got some of the basics down, I want to show you a little video that kind of gives you some more in-depth understanding of stocks in general and what a stock's all about. Hope this helps. Stay tuned.
Company stock is one of the oldest and simplest investments in the business world. In short, you're making an investment in a company. If that company performs well and grows, the demand for their stock will go up, so too will the stock price, and you can make money by selling the stock or collecting benefits like dividends. Anyone can buy stock, which makes it accessible for even the most unskilled of investors. In order to understand what stocks are and how you can make money with them, let's break it all down. Stocks are effectively shares of ownership of a company. If you own enough stock, say 5 to 10% of total shares, you'd have significant influence on how that company is run. However, most people just own 1 to 10 shares of a company, or more or less, and you still have an influence, but your votes on important decisions will be less of the total votes, so it doesn't matter as much. Most stocks sold on the open market for individual companies give you the right to vote in shareholder meetings. This means that you can vote on who is on a company's board, whether they acquire a certain company, and so on. All of that's cool and all, but it's not really why stocks are usually bought and sold. Simply to make money. Investors buy and own stock in order to make a return on their investment. You can buy a stock whenever and sell a stock whenever, as long as there is a buyer and a seller willing to take you up on the other side of the deal. Most of the time, you aren't buying from the company directly either. Rather, you're buying from another stockholder who wants to sell their position. Companies initially sell their stock in something called an initial public offering or through other public offerings after the fact. These let the company raise money without having to take out a loan. But all of that said, there are two primary ways. For one, the stock appreciates, or in other words, people are willing to buy that stock for more money than you bought it for. If the company makes great decisions and turns a profit, more and more people would want to own their stock to make money with them. This increase in demand drives the price up. Assuming the total number of stocks on the market stays the same, this is simple supply and demand. If you're selling a painting and you only have one person bidding, it'll probably go for cheap. However, if 10 people are bidding on it, it will likely go for a lot more. Stocks can appreciate for any reason, and their value is tied to a number of factors that don't always tie back to just how much money that company makes. Since stocks are sold on an open market through an exchange, their price is more of a reflection of buyer sentiment or how good or bad people think the company will do. Stocks for companies that lose millions of dollars each year can go up in price if the market thinks that they will be more and more successful very soon. The second way that you can make money by owning stocks is through something called dividends. Some stocks, but not all or even most, pay dividends. Dividends are payments directly from the company made to shareholders that come from the company's profits. Think of this as a way to entice people to buy a company's stock and hold on to it. Dividends are paid quarterly and the amounts vary by company, but it's a set amount for each company for each share that you own. Companies would want to pay you a dividend so you hold their stock and don't sell it. Supply and demand means that this will drive the price up over time. Companies want their stocks to go up so that the shares that they still own are more valuable, as well as so that any shares they decide to sell or offer in the future can be sold for more money, generating more investment money for them. We've covered what stocks are and how you make money with them, but what other technicalities are we missing? Companies sell shares or stocks in their business to raise money without taking out a loan that they have to pay back. After a company sells a share, it goes onto the open market. So after the initial offering from a company, you buy shares from other investors, not the company itself. All of these transactions are handled through stock exchanges on the open stock market.
I hope this information has been enlightening for you. Treat it with the utmost importance. This information will change your life. It's definitely game changing without a shadow of a doubt. Very important here. Remember to subscribe. We appreciate all subscribers, and this builds our channel to provide more enlightening information. Remember to hit that like button too. All the likes are important. We need you. Every single bit of your support is appreciated, and we thank you. Again, thank you for tuning in, and we'll see you next time with a game-changing video.